If you own tax-exempt municipal bonds or bond funds, or you've been considering investing in them, then you no doubt know that chronic state and city budget problems and fears of default have been wreaking havoc in the muni market. Over the past 3 months, for example, intermediate-term national muni bond funds have suffered losses of 5%, while long-term national muni funds have lost 7%. The question, of course, is whether the turmoil and losses we've already seen is just the start of something bigger. The fact is, no one can say for sure what's in store for the muni bond market. So at this point, I think it would be rash for muni investors to simply dump their holdings. That said, I think that the problems states, cities, and other muni issuers face are serious and persistent enough so that anyone who owns munis or is thinking of buying them should take due precaution to protect themselves. Here's what I recommend. First, give some fresh thought to how much of your investment portfolio you should have in muni bonds or funds. Many investors, particularly retirees, are so eager to earn tax-free income that they end up putting nearly all their investment stash into munis. But concentrating all or nearly all of your money into any single investment can be dangerous. So for no other reason than you don't want to be totally dependent on the fortunes of the muni bond market, make sure you diversify into other types of fixed income investments, including treasury bonds, investment-grade corporates, and even some CDs. Granted, even non-muni bonds have their risks these days, as my money colleague Paul Lim pointed out in a recent Money story. But by spreading your money around, then at least your entire fixed income stash won't be decimated if the muni market takes another bad turn. Second, take steps to protect against the two main types of risk inherent in muni bonds, or for that matter any bonds. I'm talking about credit risk, which is the risk of an issue going into default, and interest rate risk, or the risk of bonds losing value because interest rates rise. To reduce credit risk, stick to muni funds that keep most of their portfolios in high-quality issues, say AA or higher. To check out the credit quality of a bond fund's portfolio, you can plug its ticker symbol into the quote box at the top of any Morningstar page and then click on the Portfolio tab in the page that pops up. You'll immediately see how the fund's portfolio breaks down by bond ratings and how that breakdown compares with other muni funds. To further mitigate credit risk, I'd also suggest investing mostly, if not entirely, in national muni funds as opposed to ones that focus on a single state. By doing this, your muni holdings won't be completely tied to the fiscal health of just one state. As for interest rate risk, bonds with the longest maturities are most vulnerable. So to limit your exposure, go with muni funds that invest in short to intermediate term bonds. The Portfolio tab I mentioned previously gives a breakdown of a fund's portfolio by maturity and also provides other measures that can help you gauge a fund's riskiness. Finally, look for muni funds with low expenses. What does that have to do with risk? Well, higher expenses reduce the amount of yield a fund can pass on to its shareholders. So a high expense fund must invest in higher yielding and thus riskier issues to match the yield of a low expense fund, which means that a low fee fund can provide the same yield as a high fee fund with less risk. To see how a fund's expenses compare to comparable funds, click on the Expense tab. If you'd like to search for funds that meet the type of criteria I've outlined, high credit quality, short to intermediate term, and low expenses, you can do that by going to Morningstar's Fund Screener. At this point, it's anyone's guess about how long it will take local governments to regain control of their budgets. All the more reason to be prepared in case the turbulence we've already seen is just the start of more to come.